And Jeff, now it's time to introduce our next guest who knows a thing or two also about bonds and bond-like instruments, and that's Eric Lardner, founder of Abundant Wealth Management, a retirement income store located in Dallas, Texas. Eric, as usual, great to have you with us.
Thanks, Dave. Great to see you guys.
Eric, right out of the gate, I'm going to ask you a question. Are most people aware that there's differences between bonds and bond funds? Do the average investor understand the differences?
Definitely not. The difference between owning a bond directly and a bond mutual fund. With mutual funds, you don't own anything other than stock in a company that owns either bonds or, depending on the type of fund, individual equities. So you have the risk of loss of capital if there's redemptions. Whereas if you own a bond directly, you have a contract for a specified interest rate for a specified period of time. And as long as you hold those bonds to maturity, you get all your money back. So it's a contractual investment.
So big advantage owning individual bonds over bond ETFs or bond mutual funds. But why should a retired investor have a large segment or some segment of their savings invested in individual bonds? What would they want to accomplish with that kind of an objective, let's say?
Well, they're more stable. They provide steadier returns, and with the contract, as long as you maintain, as long as you hold the bond to maturity, you'll get all your money back. So that's the primary benefit of it, is the consistent returns and the safety of getting all your money back.
So I think the biggest misconception, though, is people and investors don't understand that they're investing by contract. And so they have a contractual agreement to do what, Eric?
To receive a specified rate of interest from the corporation that issues the bond, and a guarantee that they'll get their money back, or a contractual guarantee that they'll get their money back when the bond matures.
Right. And Eric, isn't it true that, you talk to people every day in the Dallas area, and I know everybody says don't mess with Texas, right? Texans are supposed to be tough. But I bet a lot of the people you talk to on a daily basis really, they like having those guarantees. A lot of them, I bet, like that contractual aspect, right?
Very much so. In fact, that's what gives most people a level of comfort that they otherwise wouldn't have once they understand that concept, that they do have a contract, and the corporation that issues the bond owes them a specified interest rate and all their money back when the bond matures.
So how often do you hear people say, we've talked about a lot on the show, as you heard, but I mean, how often do you hear people say, well, I don't know if I want to buy bonds now, interest rates are going up. Do you hear that a lot? Or do you think, people realize there are other factors that affect bond prices, not just interest rates?
Well, we do have, some credit spread compression that softens the blow a little bit when rates increase. However, again, going back to the contractual aspect of owning a bond, as long as you're holding the bond to maturity, you're going to get that contractual rate of interest, and you're also going to get all your money back when the bond matures. And at that point, if rates have risen, you purchase new bonds, you're going to get a higher rate.
Yeah. Yep, that's right. So in other words, they shouldn't be that concerned about it, is really the bottom line. So Eric Lardner, thanks so much for joining us today. It's great to have you here.
Thank you, Dave.